Welcome to Markets Now. I'm Michelle Rook with John Payne with HedgePoint Global Markets. And we did see mostly lower grain trade with a few exceptions in the wheat market on Friday. But over in the livestock futures, kind of a mixed trade in the cattle, hogs mostly higher. Outside markets, you had crude oil lower and the dollar higher. So, John, I want to start off with the fact that we had jobs data out and non-farm payroll. Looks like it was above expectations. And so that did influence the outside markets today, didn't it?
Yeah, I mean, I think it keeps us tight for longer, and that's being seen in the Federal Reserve odds that kind of trade kind of live. That you can see where the bets are being made, or at least the odds are for rate cuts in future meetings. The March meeting was, I think, a month ago. It was like 85% rate cut, 15% not, and now it's flipped. Now it's like 75-25 the other way.
So soybeans and the soybean complex lower on Friday. You had soybeans back below the $12 mark. And is that all about Brazil and their crop?
Yeah, mainly. I think Brazil is the reason why we're lower. I think it'll be the reason why the deferreds fall too. The soybean market has multiple problems right now that could leg it lower, and that would be one is that there's a products market right now that is essentially tight to the point where you look at front month contracts, they're basically even to the December 24 contracts. March soybean oil, March soybean meal. In the case of meal, there's a premium. In the case of oil, there's a discount. And so there's demand there that is being taken up. And I think it's more value or the anticipated value of supply and demand in the futures is kind of showing up here for beans. And in reality, it's like we could see the market kind of for beans like we saw trade last summer for corn, where if you recall, the front month futures for July were trading at what, $7? Were they at $7, $6.70, $7 for that longest period of time? And then when we went off, it was at sixes. And then when we went off and we went down, it was the September contract was already trading at $5. So you could see that for beans, I think, develop here where you have a meat market that gets really steeply inverted on the front end while the back end assumes supply is coming. And that must be through biodiesel. I don't know. China demand is certainly weak, but I think a lot of that's priced in at this point.
Yeah, it's not just Brazil. It's the combination between Brazil's prices being under the U.S., but also the fact that China's demand, there's concerns about it, right?
Yeah. I mean, we're gonna lose the residual demand. Brazil will not. That's just the way it's going to have to happen. I think for the world to continue to spin it the way it is, that would change. Chinese relations improve. Maybe there's reasons for the U.S. to become that big buyer again. But that story's out of the barn. We've lost the market share. Go look at what it was in 2014. I think it was like 65% of soybeans in the world were exported from the U.S. Now I think it's like a quarter, 30%. So there's reasons for that. Biodiesel is kind of part of the reason, but the other reason is China's continued to grow at this huge rate. So, right now that's in question. But this is all, again, I'm going to say this again, it's all kind of priced in here for grains. The worry you have is the carry, the defers that just continue to come down and trade to that front month contract. And that's where you can see the price go nowhere and you would lose as somebody who's storing physical supply through the summer.
Yeah, that's happening in both soybeans and corn. We've talked about that before, you and I. Corn could not take out the 450 resistance area on the chart this week, but corn today, did it get pulled down by soybeans as well as the crude oil market, or was it its own fundamentals?
I think corn is it's found its price, and it's going to bob around here until something would change. Either energies get a lot cheaper, which we've seen in markets like natural gas really get cheap. Could ethanol come down again? Yeah, I mean, I think energy's one to watch, and if that would fall, that could certainly break corn a higher or lower. But I would say right now lower, just based off the trends we're seeing economically. You would think that a war in the Middle East, on multiple sides of the Middle East, would scare up the oil prices. But it really maybe this is it. Maybe this is the scare. We'd be cheaper without it. I don't know, but at this point, a $60 oil price, that doesn't support $5 corn.
Yeah. What about the wheat market? Last week we had higher weekly closes. It looked like maybe we were trying to bottom again. And then this week, not really any definitive move here. What do you think we're waiting for?
Probably nothing. it's very difficult to want to be owner of wheat. At least on the Chicago side, because the Chicago has this huge. Carry. That's the theme. If you want to put a theme on today, it's dealing with carry markets, because it's not like owning stocks where you put a stock in a drawer and you can just let it sit there and it doesn't require any servicing. Commodities require servicing. They require storage. They require movement. Those get reflected on paper too. You can't just own the paper forever. You have to roll it. And right now, those roll costs, and specifically looking at Chicago wheat, are skyrocketing. So if you want to find new storage for wheat, it's going to be difficult. It's going to cost money, or you're just going to have to sit on paper that's going to put a hole in your pocket in the short run. So a lot of the wheat turning around would hinge on Russia. Russia just continues to grow at 90 million metric tons. And I would say, until something breaks with them, and that's a story that's fallen way below the radar here. I don't know. It's hard to see wheat getting more expensive without something like that happening.
Yeah, you and I have talked about it before, though, that Russia is just basically, we're not competitive to them. And so that's been the main story. Cotton market, though, is looking better. We've had 2 nice weekly closes to the upside. Exports have been pretty strong here. Is that market going to keep moving higher? Is it bidding for acres?
It's seen a nice move, especially, we've seen Chinese markets rally, then the Shanghai exchanges really got hammered later this week, and cotton stayed firm. Cotton is kind of a Chinese trade. I think from the supply side, the growing, it's going to be a tough thing to find acres for. Just there are new farmers to come in here. So it needs to keep prices somewhat steady, because the decision can still be made to grow it. But in the long term, December, you get too high too quick, you're going to pull acres from milo, from corn. But in the longer run, it's a tough market to want to own. Just given that even U.S. milling, I saw U.S. milling is at Civil War levels, 2.2 million bales, I think, is what we're going to mill in the United States next year. In 2002, I think it was 10 million bales. So we've lost all of that domestic demand, and it's also reliant on overseas apparel that, if without a global economy booming, it's hard to see, the cost of clothing going up.
So cotton right now, as far as acreage estimates, what do you think? Are we going to be down again this year, or is the market going to again be able to move high enough to pull some acres back?
Well, the S&P Informa numbers were 10.7 million. So, I was working more with cotton producers 5 years ago, and that was when the cotton prices went bananas there for a little bit, and went all the way up to we were in the dollar range, and that those days are hard to see right now. The global economy doesn't look like that anymore. So I think the acreage numbers, maybe we can get above 12 million. That's where it was 5 years ago. But it would have to come, you're talking about 1 million acres maybe coming from mile, or something like that.
Yeah. Cattle market, new highs for the move again here today. We had a strong week at cash, the push of the cattle inventory report. But how much higher do you think we're going to go here? Are the funds going to help push this thing now? Are they going to go back long like they were when we hit the record highs in September?
Well, at this point, the packing margins aren't getting better here. I mean, we've moved very, very nicely. We came off 270-ish, 275-ish on the choice, and went all the way up to 300 early this week, and we've given a lot of that back now. But at this point, the industry is healthy there, and it can handle these higher rates to a degree. The participants can, but expansion's difficult. It's so expensive. So, I will say this on cattle, the numbers of the herd are one thing, but the production numbers are something else to focus on. The production is up, so it's higher than it probably needs to be, even given where the profit margins are. So that's the thing to watch here going forward. If beef can't trade 350 this summer, 340 this summer, then it's going to be difficult for feeders to justify these levels on the deferred futures.
Yeah. And the hog market continues to be resilient, and we have been up, I think, 8 or 9 of the last 9 days. So is the cutout going to continue to help push this? Is that what started this rally?
Yeah, the hog markets have been impressive. The cutouts, bellies specifically, just it's interesting to watch the illiquid markets trade in hogs because they're fun and they there's not a lot of speculation in them. It's truly demand and coverage and things like that being put on by big players in the industry who want to buy forward. And that's the trick right now with hogs. It's like you can buy hogs forward for cheap. Not hogs, I'm sorry, pork. The cuts themselves, they're difficult to price, but right now the pricing is to the buyer. It's not that way in beef. So in the case of the cutouts, we've seen the cutout for July, for example, this year trading all the way up to 105. Last year, the high on the cash cutout in July was 112. So at this point, I think there's more to go, but it doesn't need to go to 112 right away. I don't think so. I think the banks right now they're doing banker meetings. They're trying to connect with clients as far as what the intentions are for the next, not beyond 8 months. And right now you can kind of see the market doesn't know what to do here in December, in October, where break evens are right there. We're right there at break evens for a lot of guys.
All right. Thanks for joining us. John Payne with HedgePoint Global Markets, and that is Markets Now.